Mr. President, I believe we have cleared with the two distinguished senators who are managing the bill this unanimous consent request, which is to set aside the pending amendment and call up my amendment number 857.
Without objection, the clerk will report.
The senator from New Jersey, Mr. Menendez, for himself and others, proposes an amendment numbered 857 to amendment number 738.
Mr. President, I ask unanimous consent that the further reading be dispensed with.
Without objection.
Mr. President, let me speak to this amendment. I offer this amendment along with my distinguished colleague from Georgia, Senator Isakson, to temporarily restore the conforming loan limits that expired, loan limits that we had under the law that created the opportunity for these abilities to loan at these levels. They expired on September 30th of this year. And in past years, extending these loan limits has usually occurred on the THUD appropriations bills. Mr. President, as the subcommittee chair on housing, I can tell you that getting our housing market moving again is one of the most important tasks facing our country today, because if we don't get that weak housing market moving again, we won't get the kind of robust economic recovery that the American people deserve. Historically, whenever we have been in the midst of an economic challenge or a recession, housing has been part of what has led us out of that recession. So Congress could be doing a great deal to get the housing market moving again, but perhaps the first rule that we should follow is do no harm. Do no harm. But at this point, Congress, in my view, is doing harm to the housing market and to our economic recovery by allowing the higher loan limits to expire. With this bipartisan amendment, we can easily correct this problem. The lower loan limits of the Federal Housing Administration, government-sponsored enterprises, and Veterans Administration have already resulted in a reduction of consumer credit in 669 counties across 42 states in our country. The expiration is making a weak housing market even weaker, and also makes it harder for middle-class home buyers to get mortgages when credit is already tight. And every day that passes is another day in which credit-worthy borrowers aren't getting loans or are having to pay much higher rates that could price them out of the market, and those loans aren't going to come back. Now, I recently chaired a housing subcommittee hearing on a different topic where the witnesses were not chosen for their views on a particular issue. They represented an entire cross-section of all of the interested stakeholders in the housing field, including those that were submitted to us by our Republican colleagues to consider as witnesses, and there were several. 8 of the 9 bipartisan witnesses who testified in the hearing agreed that the conforming loan limits should be temporarily extended to boost the housing market, and that now is not the right time to let them expire. One of the witnesses, Dr. Mark Sandy, the chief economist of Moody's Analytics, urged that the limits be extended, quote, for at least another year. That's a reversal of Dr. Sandy's position from earlier this year when he had supported the expiration. He said at the hearing that markets remain too fragile and that allowing the limits to expire would be an error. A recent report by the nonpartisan Congressional Research Service found that, quote, virtually no jumbo mortgages are being securitized today. In other words, in an ideal world where the private sector would fill this gap in home mortgages, the reality is that the economic conditions right now aren't allowing for that. It certainly hasn't taken place. And in terms of costs, our amendment will actually save $11 million over the next 10 years and $2 million in fiscal year 2012, according to CBO. It is more than fully paid for in a fair way by creating a premium loan fee of 15 basis points per year that would apply only to the affected loans. This makes sense because the people benefiting from the loans would be directly responsible for paying the cost of those loans, so taxpayers are made whole and no other home buyers would pay. And as I say, it saves $11 million over the next 10 years. Additionally, the amendment will likely help increase returns to taxpayers because FHA audits for the past decade have stated that the larger loans actually perform better and default at significantly lower rates than smaller loans, so allowing the larger loans could actually improve returns to taxpayers. Finally, I want to thank the co-sponsors of a very similar bipartisan bill, similar to the very essence of what we're trying to do in this amendment, that Senator Isakson and I have introduced, the Homeowner Affordability Act, where Senators Akaka, Begich, Blumenthal, Boxer, Scott Brown, Cardin, Chambliss, Coons, Feinstein, Inouye, Lautenberg, Lieberman, Merkley, Mikulski, Bill Nelson, and Senator Schumer have become co-sponsors of. And I'd like to thank the National Association of Realtors, the National Association of Home Builders, the Mortgage Bankers Association, and all the other groups that have advocated and supported for this effort. This is an important tool that we can use to boost our housing market and economic recovery at no cost to the taxpayers. I see my distinguished colleague, Senator Isakson, on the floor, and I certainly would invite him as the co-sponsor of this amendment, someone who has a long history in the private sector before he came to the Congress on the whole question of real estate. I'd be happy to yield to him at this time.